Welcome investors to a new video. Today, the company we are discussing sits at the intersection of several trends reshaping India's energy landscape. While India has already crossed 270 gigawatts of non-fossil fuel capacity, added 54 gigawatts of solar and 6 gigawatts of wind capacity in FY26 alone, and now plans to invest nearly 7.9 lakh crore in transmission infrastructure by 2032. As power generation, transmission, transformation, and consumption infrastructure scale simultaneously, one company is quietly participating across almost every major layer of this electrification cycle. And what makes the story even more interesting is that it holds a 26% market share in its largest revenue-generating business, while also maintaining a dominant position in another specialized segment with nearly 60% market share in India. So where does the story begin? As the business today looks very different from what it did in the past. While the management has guided an increase in premium product mix within the portfolio, targeting a rise from 33% in FY21 to nearly 50% in FY27. But to understand the transition journey of the premium product mix, we first need to understand the electrification value chain. Because when most people think about electricity, they usually think only about power generation. And generating electricity is only the beginning of the journey. The real question is, how does electricity reach our homes, factories, data centers, and railways? The answer lies in a massive network of infrastructure that works behind the scenes. The first stage is the power generation, where electricity is produced at solar parks, wind farms, thermal plants and hydro stations, creating the challenge of moving power efficiently across long distances to end users. Which brings us to the second stage, transmission. Think of transmission as the highway system of the power sector, as it carries electricity from generation centers across vast distances to substations and distribution centers. Once the electricity reaches these substations, it enters the third stage, transformation. This is the control center of the grid. Transformers adjust voltage levels, allowing electricity to move safely and efficiently through different parts of the network. Then comes the fourth stage, distribution. Also the last mile network carrying electricity from substations to industries, commercial establishments and homes. And at almost every stage of this journey, different infrastructure is required to keep the system running efficiently. The real interesting thing is, why is the electrification theme attracting so much attention? As India's power demand is being driven by rapid urbanization in cities, increased manufacturing activities with data centers consuming more power than ever before, EV charging infrastructure is being rolled out across the country. At the same time, India's renewable energy ambitions continue to scale aggressively with a target of 500 gigawatts of renewable capacity by 2032. In simple terms, almost every growth theme in the economy is becoming more electricity intensive. As a result, power generation and grid infrastructure must grow together. And that is exactly what we are witnessing today. India's transmission network is expected to expand to nearly 6.5 lakh circuit kilometers, while the substation's transformation capacity is projected to exceed 2,300 GVA by 2032. This is where things start getting interesting, as most people assume that whenever electricity demand rises, the solution is simply to build more transmission lines. But in reality, it is not that simple. Building a new transmission corridor can take years due to difficulties in land acquisition, environmental approvals take time, and right-of-way challenges continue to delay the projects. Historically, most transmission networks were built using ACSR conductors, and these conductors helped create the early modern power grid, serving the industry well for decades. But as power demand continues to increase and the limitations are becoming more visible due to higher transmission losses, low power carrying capacity, and greater sagging, making them less suitable for the next phase of grid expansion as industry is evolving. The grid of the future needs to carry more power with efficiency and operate at higher temperatures with low sagging. This has led to the increasing adoption of high temperature low sag conductors. What makes HTLS particularly interesting is that utilities do not necessarily need to build entirely new transmission lines. They can simply replace existing technology with higher performing alternatives and boost the capacity of the corridor. And this process is known as reconductoring. While transmission networks continue to age across India and global markets, reconductoring emerges as an important theme in power infrastructure playing out. So the company we are discussing is APAR Industries, a company that participates in premium conductor categories and has built strong relationships with utilities, EPC players, and power infrastructure companies, creating cross-selling opportunities. APAR holds a 26% market share in the conductor segment, with a global presence, caters to power and telecom cable markets, and holds nearly 60% market share in the transformer oil segment. Since APAR has conductors, specialty cables, and transformer oils business. In conductor division, utilities earlier preferred new transmission lines if additional capacity was needed, but it is difficult, so they prefer a different solution, reconductoring. For example, to move more power, we increase the vehicle capacity on the same highway, which is why HTLS adoption is increasing across transmission markets, making it a key premiumization and margin expansion strategy. Also, there is another mid-premium opportunity, AL59, a higher margin product that is accounted for in the conventional part of the business and occupies the middle ground between conventional and premium conductors. Through AL59, utilities get better performance without the higher cost structure associated with HTLS. As a result, AL59 adoption has also been steadily improving. And this is where the APAR investment thesis becomes even more interesting. Most investors, when they look at a conductor business, focus primarily on volume growth. But APAR's story is less about volume growth and more about premiumization, and the numbers clearly support that argument. Earlier, premium products contributed around 33% of the conductor mix. In Q4 FY26, management targeted a premium product mix above 50%. Even more interestingly, nearly 50% of APAR's FY27 order book consists of premium products. Now the question is, why should investors care? Because this shift is directly translating into higher profitability. In FY25, APAR generated an EBITDA per ton of 36,683, and in FY26, that number increased to 43,012 per ton. In Q4 FY26, EBITDA per ton reached 44,919. Notice something important here. This improvement is not simply the result of aluminium prices or commodity movements. It is largely driven by better product mix. Why does profitability continue to improve? That is an important takeaway from the entire APAR story. You also need execution visibility, and that is where the order book becomes important. Today, APAR's conductor division has an order book of 7,671 crores, and it does not merely reflect domestic transmission demand, but it also includes export opportunities. And when you combine India's transmission investment cycle, renewable energy evacuation projects, and the growing reconductoring opportunity, this order book provides strong visibility for future growth. Thinking about the global opportunity, is APAR catering only to domestic markets, or is there an export opportunity as well? Because there is another aspect of APAR's competitive positioning that often goes unnoticed. Over the years, the company has built capabilities that go beyond manufacturing scale. Through its partnership with CTC Global in the United States, APAR has access to CTC conductor technology, one of the most advanced HTLS conductor solutions used for grid modernization and reconductoring projects. And this is very important because premium conductor markets are not purely about capacity. They are also about technology qualifications, utility approvals, operating track records, and long-standing customer relationships. While competitors are entering the HTLS segment, building credibility with utilities and securing approvals which can take years. APAR partnership with CTC Global, combined with its established execution history in premium conductors, positions the company favorably as utilities increasingly shift towards higher efficiency transmission solutions in both India and international markets. In FY25 alone, APAR USA generated more than $140 million in revenue, while management anticipates scaling this figure to $400 million by fiscal year 29. What makes this target particularly interesting is that utility markets are not easy to enter because product approvals, qualification processes, and performance validation can take years before suppliers are accepted. This creates significant entry barriers and gives established players a meaningful advantage when large grid modernization projects begin to get executed. And the interesting part is that the United States is facing many of the same challenges as India. Aging transmission lines, creating opportunities in the global reconductoring market. Is the HTLS business driving the entire story for APAR Industries? Because within the company, there is one particular business that grew nearly 50% in FY26, and that business is CTC Conductor business. If I were to ask you today who benefits from the renewable energy build-out, most investors would immediately say conductors, and they would not be wrong. But there is another critical component required in the power value chain, which is transformers. And whenever transformer demand rises, another product from APAR comes into focus. It is CTC, or continuously transposed conductors, a winding product used in transformers. Let's understand this in simple terms. As power generation increases, transmission networks expand, substations are built, and transformers are installed. Every transformer requires winding conductors for the voltage transformation process before electricity can be transmitted further through the grid. Historically, PICC was widely used for this purpose. However, modern transformer designs are increasingly shifting towards CTC, supported by regulatory tailwinds working in its favor. CEA mandated the use of CTC conductors in transformer applications above 400 amps to help reduce power losses. Because this is not just market-driven demand but also regulatory-driven demand. And when regulation and economics start moving in the same direction, adoption accelerates quickly. In FY26, APAR's CTC and busbar business grew by 50%. The business currently operates at a capacity of 7,350 metric tons, which is planned to increase nearly 3 times to 20,490 metric tons. The management has guided to complete this Capex in 3 phases, with the first phase of Capex with 74 crores for FY27. This showcases exceptionally strong demand visibility. So where is that visibility coming from? The answer lies in India's National Electricity Plan. Between 2022 and 2032, the government plans to add 191,000 circuit kilometers of transmission lines and around 12,74,000 MVA of transformation capacity at the 220 kilovolt level and above. In other words, the transmission cycle and transformer cycle are unfolding simultaneously, and wherever there is a transformer cycle, there is also a CTC cycle. That is why I believe CTC could become one of APAR's most important growth drivers over the next 3 to 5 years. But there is another layer to the transformer story that makes APAR particularly interesting. The company does not just have a CTC business. It also has a transformer oil business serving the same customer ecosystem where they are the market leader. On clientele side, organizations like BHEL, Hitachi Energy, Siemens, ABB and CG Power, with whom APAR has already built long-standing relationships. With many of these customers through its transformer oil business, creating a cross-selling opportunity with the same customers as CTC adoption increases. Looking at another interesting aspect, the company has also supplied transformer oil for several major HVDC projects in India. And investors, we also find these small cap, micro cap and SME opportunities at an early stage through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid-cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance, and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. In FY26, management announced a Capex plan of 200 crore, primarily focused on transformer oil, lubricants and debottlenecking initiatives. This tells us something important. The company is clearly preparing for continued growth in transformer-related demand and is investing accordingly to capture that opportunity, which can potentially become APAR's most important growth engine for the future. Now let's move to the fastest growing segment where the company is a market leader in the renewable energy and railway segments, the cable business. Understanding the capital allocation probably tells the story better than anything else. The company has announced a total capex plan of 1,450 crore rupees, of which the largest allocation, 850 crore rupees, is being directed towards cables. That naturally raises an important question: why is management placing its biggest bet on cables? Today, the cable business contributes 26% of APAR's revenue, but its growth potential appears to be significantly larger than its current contribution, with management targeting a growth rate of 25% year-on-year. Talking about the metrics, the business operates at an EBITDA margin profile of 10 to 12%, and management has a vision of building a 10,000 crore cable business. What's even more interesting is that APAR's domestic cable market share today is only around 2.8%, giving the company significant headroom for growth. With the 700 crore rupees greenfield expansion at the Khatalwara plant and an additional 850 crore rupees capex plan focused on higher value cable products including E-beam elastomeric cables, optical fiber cables and advanced XLPE cable categories, management is clearly positioning the business for its next phase of growth. Where is the demand going to come from? And this is what makes the cable story particularly exciting. It is a beneficiary of multiple structural growth trends, with each theme creating a separate growth engine for APAR's cable business. Unlike many infrastructure businesses that depend, cable demand is emerging from renewable energy projects, which require specialized cables. Industries require power and control cables. Railways require signaling and overhead electricity solutions, while data centers require highly reliable power distribution infrastructure. This creates a diversified demand base for the business. Starting with renewable energy projects, which require solar and wind cables, control cables and power cables, APAR already has a strong customer base and is benefiting from continued capacity additions in the renewable energy sector. So, is renewable energy the only revenue driver for APAR's cable business? This brings us to data centers, with the industry targeting 8 gigawatts of capacity, making it one of the fastest growing segments. Data center facilities require reliable power supply, medium voltage cables, specialty power cables and bus bars for electrical distribution. While APAR is already serving data center customers through its existing relationships, this gives the company an established foothold in what could become a significant long-term growth opportunity. Then comes railways, and this may be one of APAR's most underappreciated opportunities. Out of India's 45,000 kilometers of railway electrification, APAR has participated in 31,000 kilometers of the network. Already present in projects ranging from the Vande Bharat ecosystem to international projects such as the Sydney Metro. Coming to the revenue streams driven by railway modernization, APAR participates through conductors, telecom infrastructure and specialty cables, thereby participating across several layers of the value chain rather than through a single product category. What are the major growth drivers for APAR? When you step back and look at the business as a whole, APAR appears to have three hidden growth engines. The first is conductors, where products such as HTLS, AL59 and CTC are helping the company move up the value chain, supported by regulatory tailwinds including CEA mandates. The second growth engine is the cable business with a 25% growth target and a long-term revenue aspiration of 10,000 crore rupees. The third growth engine is transformer oils. APAR holds nearly 60% market share in India and is among the leading players globally. Together, these three businesses create exposure to multiple infrastructure themes rather than a single growth cycle. But there is another growth driver that often receives far less attention: APAR USA. Over the last few years, the company has quietly built a meaningful international platform through APAR USA, with revenue contribution expected to increase to $400 million by FY29. Are there some emerging opportunities that could become meaningful over the coming years? Let's start with defense. The revenue contribution today is still relatively small, but the strategic importance of the segment is much higher because defense markets naturally have high entry barriers, approval requirements, and lengthy qualification cycles. And once a supplier is approved, customer relationships tend to remain sticky for many years, where they are DRDO and Navy approved. For subsea cable solutions, underwater LV and MV cables, and integrated fiber optics, in other words, APAR is beyond conventional business. Then there are EVs, where they make EV wiring harnesses for JBM and Electra. Traditionally, transformers used in data centers had air cooling systems, but APAR has efficient cooling solutions. While the revenue is negligible, successful adoption will open up new market. So APAR has an exposure to RE, data centers, railways, defense, EVs. But if the opportunity is this large, what are competitors doing? Because identifying a growth opportunity is only one part of the investment thesis. And understanding why a company can capture that opportunity is what ultimately determines long-term value creation. In the conductor segment, APAR is generally compared with players such as KEC International, Sterlite Power and Diamond Power. What makes APAR stand out is not just its scale, but also the quality of its product portfolio. Today, APAR has a conductor capacity of around 444,607 metric tons per annum, one of the largest in the industry, along with an additional expansion pipeline of 70,000 metric tons per annum. Another advantage that is often overlooked is its manufacturing footprint. APAR operates manufacturing facilities across multiple locations, including Gujarat, Odisha and Dadra and Nagar Haveli. While many competitors cater conventional conductors, APAR focuses on premium product mix. And that is the reason for high profitability. In peers, Diamond Power is a competitor in the ACCC premium segment. However, it remains at par in terms of competition as APAR has an established performance track record and a developed clientele base in the conductor segment. At roughly half the capacity of APAR, Sterlite Electric, formerly Sterlite Power, is also in the conventional and premium conductor segments with highest Capex commitments amongst peer group. Now let's move to cables. This is where competition becomes even more intense. However, the overall industry is growing at a double-digit rate, with market leaders such as Polycab, KEI, RR Cable and Finolex. Compared to them, APAR's domestic market share is low from an investment perspective, but it is the biggest opportunity because APAR has the largest runway for growth. The company currently operates around 880,176 kilometers of cable capacity and is investing aggressively to expand that capacity further. What's important is APAR is not trying to compete in mass market housing wire segment. They are focusing on RE cables, railway and defense cables. And this is why management is allocating a large portion in the cables Capex. In peers, Polycab is a distribution-led business. They increase their market share to 31% in FY26 and have an investment plan of 5,000 crore until FY29. Now let's talk about the oil business. The company has a specialty oil capacity of over 861,600 kiloliters, making it one of the largest players in the industry and holding 60% market share. While this business may not attract as much attention as conductors or cables, it plays a critical role in the power infrastructure value chain. Every transformer requires insulating and cooling oil for reliable operation, making transformer oil demand closely linked to grid expansion, transmission investments, renewable energy additions, and industrial electrification. What makes this business particularly valuable is that it strengthens APAR's relationships with transformer manufacturers and OEMs, allowing the company to participate in projects much earlier in the supply chain. As a result, the oil business is not just a stable cash-generating business, but also an important strategic business that deepens customer relationships across the power ecosystem. The company has also built a strong global presence in specialty oils, exporting to multiple countries and supplying products to several leading transformer manufacturers. This provides APAR with a diversified revenue stream and reduces dependence on any single end market. Now, perhaps the most important signal comes from management's capital allocation decisions. Out of the planned 1,450 crore rupees capex, around 400 crore rupees is being invested in conductors, 850 crore rupees in cables, and 200 crore rupees in oils, sending a very clear message. Management expects conductors to continue performing well, believes the oil business will remain a stable growth contributor, but sees the largest future growth opportunity emerging from the cable segment. If I had to summarize APAR in 5 points, this is how I would describe the investment thesis. First, the transmission build-out opportunity. India is expected to undertake one of the largest transmission expansions in its history by 2032. And APAR is already one of the leading players in the conductor market, making it a direct beneficiary of this investment cycle. Second, premiumization, where the company's premium product mix has increased from 40.6% to 49.3%, with EBITDA per ton improving from 36,683 rupees to 44,919 rupees. What's even more impressive is that this improvement has been achieved while maintaining revenue growth of 10% year-on-year in the conductor business. Third, the cable business. Management is investing 850 crore rupees into this segment. The company is targeting around 25% growth and has articulated a long-term aspiration of building a 10,000 crore cable business. Fourth, the CTC opportunity, where the business grew nearly 50% in FY26 and is expected to continue growing at similar rates. Fifth, the global platform. APAR USA, the company has international presence. With this, we need to always consider every investment opportunity comes with risks, and APAR is no exception. The first risk is linked with transmission expansion cycle getting delayed due to right-of-way approvals. Second risk is cables expansion, where they should utilize capacities to gain market. Third, adoption of HTLS, AL59 or other premium products should not slow down. The fourth, APAR USA, an important growth platform for APAR if utility spending, infra investments or data center capex in the US get slowed down. Now let's summarize the entire discussion. Today, APAR holds a 26% market share in conductors, around 50% share in HTLS segment, a premium product mix targeted at 50%, and an order book of 7,671 crore rupees. Its CTC business grew 50% in FY26, operated at 98% utilization, and is expanding capacity from 7,350 metric tons to 20,490 metric tons. At the same time, management's biggest growth bet is on cables, where more than 850 crore rupees of capital is being deployed with the ambition of building a 10,000 crore rupees revenue business. In specialty oils, transformer cycle with RE, data center and railway growth, APAR is the beneficiary. Execution will be the key factor for APAR. The real question is whether opportunities get converted into sustained revenue, margin expansion and market share gains. Identify such small cap, micro cap and SME companies early through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. That's it for today's video. If you found this detailed breakdown useful, then like the video, subscribe to the channel and comment below sprint if you like the detailed research. We will meet again next Saturday with another video at 11 am.